Good afternoon. My name is Melissa Monahan, and this is my presentation on sensitivity analysis for Business 604 summer session with Dr. Wu at American Public University System. So, to begin with, I will be going over goal and functions of financial management, as well as qualitative steps, quantitative steps, internal financial methods, and external financial methods, and how these project risks integrated into capital budgeting analysis operates. So, before we get ahead of ourselves, overall goal would be profitability, growth, efficiency, and stability. Just to quickly review, sensitivity analysis is a tool that helps calculate the importance of a particular assumption. It helps avoid to waste time on variables that have little effect on the outcome or that may cause loss. It shows the magnitude of changes in outcome, like profitability, through various scenarios using different variables. Maximizing profits, growth, and stability by efficiency are, of course, going to be the main goals. And in order for a company to grow profits, there needs to be a flourish and have a history, financially speaking, and a well-kept track record of it. While making a lot of money is a goal, so is stability. For example, one good year versus a track record of 3 bad years in a row do not provide stability nor a good track record. Functions of financial management include balance sheets, investors, and capital. Balance sheets provide insight to a company and their expenses, as well as where money is going to, how much is made, and it leaves little to no room for interpretation or gaps. Investors show interest in balance sheets to dictate an amount to give, earn, and track for themselves as well. An attractive balance sheet gets the attention of investors, stakeholders, and provides comfort and reliability. Capital includes assets, liabilities, cash, accounts payable, and long-term goals for a company. A lot of capital equals better security and projected longevity of said company while building a better reputation for itself. So, qualitative steps include variable relationships, exploring the unknown and assets, understanding risks, and potential relationships. So, as a quick refresher, qualitative steps are non-numerical. They're often expressed through words, descriptions, and again, not through numbers. And it focuses on how and why in this, for example, scenario, why a company makes decisions and how it affects the consumer. So, variable relationships are to be examined as it needs to be determined if one variable might affect another or the relationship with a potential desired outcome such as profitability. Exploring the unknown and uncertain variables/drivers and potential scenarios avoid wasting time, resources, and finances, as well as labor. It assesses if it's worth investing in external variables that might influence or change an outcome. Provides insight to risk and potential opportunities with said variables and sets up a path for scenario analysis by exploring the unknown. It examines what is controllable versus uncontrollable. Understanding risks and weighing the validity of or not while maintaining relationships and reputations. Provides feedback and opportunity for stakeholder involvement or concerns. Quantitative steps include key variables as mentioned before, best and worst case scenarios, and this will be represented numerically, and representation. Quantitative steps provide a numerical results and a value for critical drivers/key points. It calculates results and presents a baseline with numbers. Key variables means understanding what specific variables like cost of materials, sales volumes, or interest rates, all numerical, are to be studied/focused on. Best and worst case scenario means creating a range and baseline of data of variable. It, as stated, provides best and worst case scenarios to avoid wasting resources and efforts. It enables companies to examine individual variables and assign ranges of values to them. Thus, each combination of values equal different scenarios. Examining results and calculations mean to examine the impact on the output metric, such as profit, using the net present value (NPV). The results can be read via visual representations, such as sensitivity result tables created on Excel. And now we'll be talking about internal financial methods. As mentioned previously in the slide before, net present value (NPV), internal rate of return (IRR), and payback period. So net present value is based on the discounted cash flow. If the project's NPV is positive, then it is earning more than the cost of running the operation/project. It's a good investment due to earning more than the cost of capital. However, if the NPV is negative, then the profits are low or none, and investment should be canceled slash not further to be pursued. The internal rate of return (IRR) means the discounted rate focuses the NPV of the cash flows to equal zero. It does not rely on external interest rates of financing costs. It shows how profitable the project is through internal means, and again, does not take any outside factors into consideration. Payback period means the amount of time required to recover the initial costs of the project in years. It calculates the cumulative cash flows for the project beginning the initial cash outflow, then adds each cash inflow until the total is zero or higher. Overall, it projects risks integrated into a capital budgeting analysis by evaluating project risks within company data and uses internal cash to fund projects. Now we'll be going over external financial methods. This includes Capital Asset Pricing Model, CAPM, Market Analysis, and Weighted Average Cost of Capital, WACC. The Capital Asset Pricing Model, CAPM, is an external financial method based on the idea that investors who have a higher systematic risk should be rewarded more for taking on this market risk. It's systematic and is not a stock's individual risk because firm-specific risk can be eliminated through diversification. Market analysis reflects economy and forecasts recessions or booms, and how the external funding can harm or help the external funding. The capital asset pricing model can have an influence on capital budgeting by its effect of the weighted average cost of capital. A higher WACC means higher risk and potentially higher project required return. And there's a cost of debt from external sources. And these are my references. Thank you.